Good afternoon, welcome. It's a great pleasure for us here at Goldman Sachs to welcome our next speaker, Bill Winters, Chief Executive of Standard Chartered. Bill, it's really a great pleasure to welcome you again this year here at the conference. Thank you for making time.
Very nice to be with you, Martin.
And with that, let's straight move to questions, and maybe to start off with broader economic questions, just as we're approaching the midpoint of the year. If we look at developments in certain Western countries, particularly the US and the UK, are progressing very firmly on the vaccination programs, and the debate has now shifted to the pace at which the economies are being reopened. At the same time, the picture in Asia and certain Asian countries looks a bit different, with a number of countries being in the process of containing the pandemic. And I was just wondering, how does this different outlook between certain Western countries, between certain countries in Asia across the footprint of Standard Chartered impact the outlook for your business growth here, both in the short term, but importantly also in the longer term?
Yeah, thanks. Obviously, a very topical question. In the longer term, I think the short answer is not very much. I think we see we've already seen in the US and now more recently in the UK and in the rest of Europe, a relatively quick resumption of the patterns of growth. And of course, we saw that in China last year. So I think that we're all hopeful that the recovery, and certainly in the more developed countries, can come pretty quickly. But when we look at the state of play right now, it probably breaks into three broad groups. There's the countries that are well vaccinated and well on their way to recovery, where the only question is, does it get slowed down a bit by Indian variants or Delta variants, things like that. But we're very encouraged by what we've seen so far. Second are countries that actually have and I would say China is in that category, where the Chinese economy is relatively humming. And of course, they're withdrawing some of the fiscal and monetary stimulus, which is taking some of the wind out of the economic sails. But I would say that's a good thing. It's not necessary, and they're recreating some powder should they need it for something else. And I think the second category are those countries that where the health situation is quite under control, certainly relatively, but where the mobility restrictions have kicked in hard. And the most obvious for us in that regard is Singapore, where the degree of restriction and quasi lockdown right now is quite high, despite the fact that while the number of cases is high by Singapore standards, they're not high by relative to other populations. And we just have a few markets in that category. You might include parts of Hong Kong there as well, although Hong Kong is coming out the back end. But we have seen a little bit of softening of economic activity, and in particular consumer spending during these sort of quasi lockdowns in two of our very important markets. And then the third of the countries where, unfortunately, the pandemic is not under control and the vaccination rates are relatively lagging. And the big one for us is India, and that's obviously very much in the news. You don't need to talk about the backdrop, but it certainly extends for us into Bangladesh, Sri Lanka, Nepal, and Malaysia. Nowhere near as bad from a health perspective, but in a pretty restricted environment right now. Indonesia just a bit behind that. So the interesting thing to note in that third category is that this wave is nothing like the earlier waves. So the level of economic contraction is actually far less, despite the fact that the level of infection and hospitalization is, in the case of India, very high. In the case of the other markets, relatively high. And I think that reflects the economies where we operate, the ability to cope and be resilient in this new world of infection. So we've not seen a significant pickup in loan impairments. In fact, we've not seen any pickup in loan impairments, always with the caution that in a place like India, it may be early to declare any kind of victory, given how acute the crisis is right now. And we've not seen the collapse in economic activity that we saw in the first wave of sort of nationwide lockdowns in these places, as people have learned to cope. So I'd say long term, no structural concerns. Short and medium term, there could be some bumps and some hiccups. Clearly, a lot to focus on, but nothing for undue concern.
Thank you. And then moving to the broader growth opportunities of the group, and maybe to start on the inorganic side, so the prospects and opportunities for M&A. One of your US peers has announced recently its intention to exit a number of markets in Asia. Could there be a scenario where Standard Chartered scoops up some of the assets, some of the portfolios, some of the businesses? Or could there be another scenario that even if that was not to happen, that Standard Chartered could benefit by some of the disruption caused by the sales process?
I think the answer is yes in both cases. If we're looking at the assets that Citi has put up for sale, we operate in a number of those markets, not all of them. So we've exited earlier markets like Thailand and the Philippines. We've never, or at least not for a very long time, had a retail presence in markets like Australia. So there's some things that probably make less sense for us. But in the other markets, Citi's got some good businesses, and they could be complementary to ours. Thankfully, we've got pretty good momentum in terms of getting to scale in each of those markets, either through digital channels or otherwise, that give us the opportunity to grow organically if that's where we end up. That's been the plan so far, and if we don't end up buying any of the assets from Citibank or anything else, then that's where we'll be going forward. We feel fine about that. But if there's an opportunity to do something that is strategically and financially accretive, we will. Maybe to anticipate one of your other questions, we would look at any material acquisition through the lens of what else we could be doing with that capital in terms of the rest of our operating businesses, the rest of our investment portfolio, fully recognizing that our stock is trading at a deep discount to book. So we would expect to need to make the case to ourselves and then to the world that this is something that is compelling relative to our other opportunities. And if we can get there, fantastic. If we can't, no problem.
And then maybe more broader on growth, organic growth opportunity within the group, just given Standard Chartered's footprint. Which growth opportunity are you most excited about? And maybe also to touch upon China. There seem to be more and more peers heading into the Chinese market with partially quite ambitious hiring plans. How is the proposition evolving there for Standard Chartered? And do you see this as an increasingly competitive space?
Yeah, look, I mean, it's actually a slightly tough question to answer because we have a lot of things that I think are very exciting. And I would say sustainable finance is very exciting. The amount of money that needs to go into our markets to affect the transition to net zero is staggering. Right? We're talking about trillions of dollars in an area where we're actually very good. And you may say, yeah, but that's fine, but it's not going to be the priority for Nigeria or for India or Sri Lanka. But the fact is, it is the priority, not necessarily because it's a government priority, although I think in many cases it is, but because the businesses are supplying global MNCs who themselves face tremendous pressure from their own shareholders and in some cases their home countries. So I think there's a huge wind at our backs on the sustainable finance front. But when we get down to the most exciting single opportunity, it's got to be what's happening in China. I mean, our China business was on fire last year. That's a good thing, by the way. It's a good fire. It's continued into this year with very, very strong growth, with the advent and the acceleration, really, of Wealth Connect in the Greater Bay Area. The opportunity for us to take a very strong and fast-growing wealth business in China already. Right? So we were generating good growth in wealth independent of Wealth Connect. Obviously, we've got a super wealth business in Hong Kong. Those two things have been linked for some time. So we have a head of the Greater Bay Area, right? He's a country CEO, or it's a sub-country, obviously, but he's a peer technically of our head of Hong Kong and our head of China. Why do we do that? Because we have made the bet quite a while ago that that's a single market: Hong Kong, Guangdong Province, Macau, and that is also obviously a gateway to the broader Chinese market. So we're set up to capitalize on Wealth Connect, offering international asset management products through to Chinese investors who are increasingly able to deploy their resources into non-RMB assets, but only through a reasonably well circumscribed and prescribed scheme like Wealth Connect, where you need to have a partner in Hong Kong, a partner in mainland China. Of course, we have those two entities already, but we can also partner with other people in Guangdong Province. So I see a big opportunity in China broadly, and in wealth in particular, and then in further particular in the Greater Bay Area, which of course is close to 10% of the Chinese population, more than that of GDP, the fastest growing, the most private sector dominated, and on the doorstep of Hong Kong.
Thank you, Bill. And then to follow up on one of your earlier comments in terms of how you balance growth and capital return, the Bank of England is expected to provide an update on the final restriction on capital distributions before interim results, so quite shortly. And that obviously puts this kind of question under much more spotlight. Can you just elaborate a bit more how you think about these opposing goals of, on the one hand, I mean, you were stopped doing a buyback when the pandemic hit last year, doing a buyback with excess capital now versus the growth, either organic or inorganically?
Yeah, obviously it's a question on all of our minds, and we don't want to try too hard to read tea leaves. I mean, we'll know soon enough what the PRA is comfortable with. I would note that when we were able to return to distributions earlier this year, we activated both our buyback program as well as a dividend at lower levels than had been the case pre-pandemic, but never, obviously earnings were at a lower level as well. So I'm not at all discouraged about the PRA's approach to capital return via buyback. Our position is the same. We would like to actively manage within this 13 to 14% range. Perfectly comfortable going down towards the bottom end of that range if the economic environment suggests that that's the right place to be. And clearly, as things improve, we're getting there. But we want to operate within that range. We want to be able to grow our dividend with earnings, and we want to be able to return the excess above that to shareholders once we've satisfied our investment appetite for compelling investments. And as I just discussed earlier, our definition of compelling makes reference to the fact that our stock is trading at a discount to book value. So what that means we come out with at the half year in terms of interim or the full year, I don't know. Not gotten any more guidance on that from the PRA. But I would say just looking at the environment, things have clearly gotten better. And I think that the PRA the Bank of England is very happy with the way the banking sector generally performed through the pandemic and the way Standard Chartered in particular performed through the pandemic. I mean, every indication is that there's confidence built that we're in the right place. And I would hope that translates through to an ability to manage our capital sort of unfettered along the lines of what we've discussed, and we'll see.
Let's move to the trading environment and outlook. Maybe starting with how should we think about progression of NII from these levels? Interest rates are low, but equally there are discussions around inflation. Have we seen the kind of inflection point now in terms of NII with margins being roughly stable and from here loan growth to drive NII expansion?
Yeah, I don't know if we've reached the inflection point. I think we probably reached the bottom, and maybe there's as we saw in Q1, there was a very, very small reduction, and as we indicated, we thought we could sort of hold that level from here. Yeah. And that's a combination of some of the underlying drivers of lower NII. Would note that HIBOR has reduced modestly, for example, but offset by higher quality liabilities from the rest of our activity, and then obviously there's asset growth. And asset growth was very strong in the first quarter. Wouldn't expect that we can repeat that in each of the following quarters. But I think when viewed through the year, we continue to believe that we can grow assets at a healthy clip. There's the various steps that we're taking in terms of managing our treasury portfolio that should further support NII to some extent. And then there's the ongoing improvement in the quality of our liabilities, improving the treasury operating account balances, the high quality CASA, which should allow us to continue to get some growth back into NII in the quarters to come.
And then moving to the structural hedge, some of this discussion obviously came up with first quarter results about the potential and scope here to enter into structural hedges to defend margin going forward. How meaningful a contribution can such a hedge have over time? And could you also talk about the sensitivity of Standard Chartered to higher interest rates?
Yeah, well, the idea of the structural hedge is not new. I think it's been a feature of bank capital strategies for some time. We've assigned historically a pretty low short duration to our underlying liabilities. And that reflected the fact that as much as we'd like to, we don't have the volume of super high quality deposits that others that have a much bigger home market might have. Now we've improved that quite a bit as we focus not just in Singapore and Hong Kong, where we do have sort of home market type positions, along with a few other markets that are a little bit less economically impactful, but nevertheless very, very strong positions. We've improved the quality of our liabilities. We've also watched behaviorally how those deposits act and how they behave in different rate environments. And we'll be increasingly comfortable that we can extend the duration of our assets in the treasury portfolio against those liabilities. And you call it structural hedge. The impact as we ramp that out, and of course we're perfectly aware that while short-term interest rates are extremely low and the yield curve has steepened a bit, we're at a low point in the rate cycle, right, by almost any measure. So we'll want to be very careful about extending the duration of our assets. But we think this could add tens of millions of dollars to our bottom line as we introduce different types of structural hedging over a period of time, all along the lines of better matching our assets to, I would say, an analytically refined understanding of our liabilities.
And in terms of rate sensitivity, so for any 100 basis points move, how sensitive is the group?
Yeah, we gave some guidance at Q1. Nothing has really changed since then. What we tried to do was to add to the guidance that we given earlier to make clear that there's the direct impact of higher rates, but also the behavioral impacts of higher rates, including where we position our book in financial markets. So I have nothing that I can add specifically to what we said in Q1, other than to say that it's an area of tremendous focus for us, and we certainly haven't seen anything that's driving a change.
Let's move to financial markets and wealth, and both off to a very strong start to the year. Given that volatility in emerging markets seems to have leveled off a little bit, should we still expect financial markets income potentially to edge higher this year, and maybe similarly on wealth management, off to a very good start in the first quarter? Do you think this kind of pace can be maintained for the rest of the year?
Yeah. So both those markets, as we've always indicated, but both those product lines are very market sentiment affected. And the first quarter was very, very strong in each case. The second quarter has certainly slowed, so we've had much lower volatility and in financial markets broadly, and also I'd say broadly a plateauing in equity markets with some volatility that has made investors a little bit gun shy. But the good thing from what I'm seeing is that the number of new customers that we're adding and the AUM that we're adding that those customers bring is continuing to grow quite nicely. And so when I look at the ability to sustain this high single-digit, low double-digit growth in wealth management, financial markets maybe it's a little bit less than that growth rate, but nevertheless a good, healthy, robust growth. Drawing through the volatility of market sentiment and the like, I feel very positive about the ability for those businesses to continue to grow. Now, from quarter to quarter, much more difficult to forecast. April was quite slow. May has improved substantially. We're getting into June now. It looks okay. We'll see how this develops. But over the course of the year, there's no reason that we can't match or even exceed last year's levels.
Thank you. And then moving to costs. So your guidance suggests that you're managing the whole cost base of the bank very tightly. Just looking in light of the prospect for a fast or very fast economic recovery this year, do you see this as the right strategy, or could there be a scenario where there's more opportunity to lean into the recovery and for costs or investments to be temporarily higher in such a scenario?
We've got a pretty full investment program already, and we've maintained a strong investment program through the pandemic and into this year. So there's not a lot of unbelievable projects that are left on the cutting room floor as it relates to the 2021 budget. That's number one. And number two, the cost focus is really very much on driving improved productivity in our business, and this is benefiting from the earlier investments that we've been making. So when I look at our ability to get under this $10 billion number, and that keeping in mind is a constant currency number, and as we noted in the first quarter, there was maybe $300 million or so of currency-related expense increase. As you also know, that's offset by the same amount roughly on the income side. So it's no impact on operating profit. But I wouldn't want to get too fixated on the $10 billion number when we know that that's a constant currency number. But the productivity gains that we're generating from earlier investments and then ongoing activities is the bulk of what's allowing us to fund our investment program. So it's a discipline that we've maintained now for 5 years plus. We're not going to lose it now. We have indicated that if we have a very strong performance, and obviously it would be nice to be able to repeat Q1 3 or 4 times between now and the end of the year, then there could be some performance-related pay that would drive the expenses increase,
Yeah.
drive the expenses up. But apart from that, no, I think we can manage without shortcutting or shorting the investment spend. We can manage to maintain the expense discipline.
Thank you. Let's move to asset quality. I remember last year the whole discussion was around how severe a credit cycle are we going to get, and over the last few weeks, few months, the discussion has almost completely turned around in terms of how low can risk costs go this year, how quickly can they normalize, what is the scope for write-backs. What is your latest on asset quality? Are there any particular pockets to be worried about still? Are we through it? And could we enter into a scenario where for a couple of years risk costs could now actually undershoot, just given that we had this kind of stress scenario over the last one and a half years?
Right. I think there's two parts of that question, or two answers. Both are encouraging. In terms of short-term impact, or impact from the ongoing activities, while we're watching things like the developments in India very closely and looking for possibilities of some dislocation, as I mentioned earlier, so far things seem to be very under control, and business is carrying on. Companies are able to fund themselves, and we're not seeing any acute signs of stress in the financial markets. Plenty of stress in the human market. So we'll continue to watch that. But that said, we're very well reserved, very well provided for. We continue to have a management overlay that we have not materially released, and we feel very good that the ability to run with lower impairments for some time should be in place. The second way to answer the question, though, is are we comfortable with our underwriting standards? Are we comfortable that we really have changed the nature of our bank in terms of the asset quality of assets that we originate over the past several years? And again, the short answer is yes, we're very comfortable. There have been losses in the broader financial markets. Other banks have had some losses, and it may have been offset by other things, but there have been losses. And we've not avoided everything, but we've avoided most of it. So I think the quality of what we have on our book is really very, very, very strong, and our underwriting standards are strong as well. And that also gives us some latitude to, I won't say go crazy, because that's not what we're going to do. That's not our focus at all. But there are some areas where we're relatively light in terms of credit exposure. The most obvious one is unsecured consumer credit. We've got, I would say, maybe a dozen pilots going on where we will test, learn, experiment, and refine, and on various forms of consumer credit, alone and with partners. And so these are the opportunities that come from having quite a clean book to begin with, and a really good set of underwriting standards from which we will not deviate. Right, but we're not throwing that rule book out. We're just going to find ways just to see if we can get some incremental, really strong risk-adjusted profits on top of that.
That's a great note to move to our next topic, innovation and technology. And firstly, I would like to ask you about some of the platforms you have recently launched. So, number one, the Mox digital bank in Hong Kong, but also Nexus, so the business as a service platform. Could you just give us a bit of color? How has the evolution here been in terms of both platforms, and what could the scope be there within the broader growth concept, growth opportunity for the bank?
Yeah, we're very excited about the way that this is going. I mean, Mox has been a huge success. So we are still have we're now a bit over 3% of the population of Hong Kong banking with Mox. 70% of the clients that signed up are active. Average balances are at a very high level relative to other bank balances in Hong Kong. We're the first bank, first of the virtual banks, to launch a credit card offering. It sits alongside the debit card offering that we had. We're beginning to roll out incremental credit products, revolving credits off the card, but then personal loans, and then we'll follow up from there with trading products, wealth products. Eventually, the world will open up, and travel will resume. In addition to making our partnership with Trip.com much more effective, we'll have an additional earning stream coming from FX, in particular for people that travel. So, but we've got a 4.9 score in the app stores. That's on a scale of 5. It's the highest of any of the Hong Kong virtual banks, and basically the highest in the world. It's the most reviewed of the virtual banks. So thousands of people literally are offering their comments, and they love it. We had very low marketing spend early on. In fact, we were prohibited from marketing under the regulatory guidelines. That's opened up in the past month, and we're having a step a full step up in terms of daily account opening, so 800, 1,000 customers a day. So that looks good. We're going to drop that bank into Singapore, assuming we get all the final regulatory approvals, which no doubt we will. Actually, no doubt. That's presumptuous. I expect we will. And we'll have a partner that we haven't disclosed yet, but that I would say is every bit as compelling as Hong Kong Telecom or Trip.com in Singapore in terms of somebody who's additive to what Standard Chartered would bring in terms of customer access for a digital bank. Of course, the Singapore market is very different, and it's I would say in some ways it's probably already more digital and with a better range of digital offerings from incumbent banks than has been the case in Hong Kong. So we'll have a different set of propositions, but it's no less exciting for us. Nexus is very, very different, right? Nexus is a technology platform that we built to deliver a full range of banking products through e-commerce channels. And the one that we've announced, the first one that we've announced, and we've got our first customers on board now, is a partnership with Bukalapak. So Bukalapak has 100 million plus customers in Indonesia, growing very fast. When we started the discussions with them 18 months ago, they had 60 million, just to put it into perspective. These are people who are buying stuff on e-commerce platforms, right? So these are people that have some money, some savings, and some demand for credit. And we'll offer a full range of banking products. It will have all the convenience of an integrated consumer platform with the ability to. I don't think the customer won't really know that they've moved from the Bukalapak platform to a Standard Chartered bank product, but they'll have all the convenience of a regulated, safe, sound, and efficient bank with all the convenience of a consumer platform. We've got 2 other e-commerce platforms in Indonesia lined up, which will be next. We're developing those opportunities in different markets. And the technology platform that we built eventually will also suit other banks. So it's a platform that can be separated from Standard Chartered, should it prove to be effective and in demand, so that other banks can originate banking products through other e-commerce channels using our technology platform. So we're very excited about this. The technical rollout has gone very well. We'll be into something closer to real scale with Bukalapak customers within the next couple of months. And then we'll continue to roll out products and services, including buy now, pay later, and a full range of other credit services towards the end of this year and then into next year.
So it seems like these digital platforms, they could be a nucleus, number one, to address the comparatively small market share in a number of markets Standard Chartered has maybe in a couple of years in the future. But it could also be a nucleus into developing your consumer lending proposition. Is that right?
That's right. Like Martin, as you and I have discussed before, and we've discussed in other earnings sessions, our view of basic transaction banking, and I mean at the consumer level, is that you either own the platform, which in the case of the partnership with Bukalapak, of course, Bukalapak owns the platform, no question about that. But we will be an integral part of that platform, not easily segregated. But yeah, we'd love to wake up tomorrow and be Ant Financial or be Amazon, but it's not going to happen. So you either own the platform or you plug into the platform, and because customers are going to get the convenience that comes from the platform one way or the other. And in Hong Kong, we're effectively partnering on the platform with Hong Kong Tel and Trip.com, and Indonesia we're doing that with Bukalapak and others. In Korea, we're doing that with Toss Bank, with a bank that should go live shortly. In Taiwan, we're doing that with Line. In each case, we have a minority stake that have contributed to the creation of the bank, but it's not our platform. But we have an ownership stake in the platform, and of course, we'll be providing banking services into that platform as well. But in other places, either because regulation is a defense, and regulation is a defense in some cases, we have the opportunity to digitize ourselves. So I think we're in the process of creating those platforms in Africa. Our digital bank has gone from digital banks really across 9 markets have gone from strength to strength. And now we're able to offer more and more lifestyle products, obviously a broader range of financial products. And we can partner with telcos. We are partnering with telcos. We can partner with e-commerce platforms. But we had that luxury because of the core digital capabilities that we built and the customer acquisition and the customer satisfaction that's come from that. So yeah, I feel good about our position in that space. And at a time when some are identifying the mass market as a deathbed for banks in favor of technology companies and non-banks, for us, we're calling for the first time in a while a chance to generate some decent growth and profitability from that segment because of the investments that we made in digital and because of our ability to partner so well.
What what else are you working on? I think you hinted before there's a number of initiatives you're working on. What other interesting projects are you working on? And also referring, I think there was an announcement earlier, I think last week, about a joint venture in the crypto space, so both crypto exchange and custody. How do those fit into the broader framework?
It's definitely part of the framework. We've been building out a digital asset ecosystem that started with a custodian. We built this custodian in house. We then partnered with Northern Trust. We're getting the final regulatory approvals in place, and that's driven by the observation from a lot of our institutional investor clients. They're active in digital assets. They expect to be much more active. And keeping in mind the digital assets, it kind of starts with Bitcoin and Ethereum, but it eventually will move much more broadly into a broad range of tokenized assets. And they were uncomfortable dealing with one entity that maybe was a startup, maybe not so well regulated, that was doing their broking, their exchange, their clearing, their custody, etc. And they want some segregation of services. So we built this custodian. As soon as we're able to get that out into the real world, and it's largely built at this point. It's just a question of getting the approvals in place. And we think there will be a lot of demand for that custodian. The joint venture that we set up with OSL is they have a crypto exchange is a crypto exchange company in Hong Kong. We were creating a European exchange / marketplace, again, for starting with cryptocurrencies, but then looking at a broader range of digital assets. That fits very nicely into the custody equation as well. Separate entities, complete separation of responsibility, but we'll build the ecosystem. At the same time, of course, we're looking at how we can use digital assets broadly, cryptocurrencies in particular, as means of exchange for cross-border payments and for settlement, and whether that means working with the likes of Facebook on their various ventures. Obviously, that DM Novi project has taken a new turn as they redomiciled from Switzerland to the U.S. Very interesting change. It certainly suggests that the U.S. is intending to embrace this market rather than try to curtail it, which was some of the speculation before. I will see just how warm and cuddly that embrace is. But the number of banks, central banks that are looking at central bank digital currencies now. So we're as close to the Chinese CBDC as any foreign bank can be. But that certainly is an area that we think will become important as a mechanism for trade, as well as a mechanism for the Chinese to roll out their policies, in particular in the Greater Bay Area with Wealth Connect, things like that. So allowing currency convertibility, but in a controlled way that you could only do with a programmable currency, like the PBOC's digital currency. So I say digital assets is an area of focus for us. I'm spending some time on the carbon markets. There's a task force we got like 450 members now, who's looking to build a really big, robust, legitimate, credible market for voluntary carbon credits. That's a growth opportunity. Yeah, it's also the right thing to do, and it's the way to help all of us and our clients to affect their net zero transitions. It's also a very important component of the sustainable green finance equation. The companies that don't have access to all the capital they need in the emerging markets in particular, by monetizing the greenhouse gas reductions by the sale of carbon credits, they promote the financeability of these projects. So these are a few of the innovative areas that we continue to focus on.
Thank you. Let's move to sustainable finance, and you mentioned it at the beginning. And how important is it to maintain the pace in sustainable finance, and where do you see the opportunities or threats for Standard Chartered going forward?
The threats are medium to long term, and the threats are that we fail on this transition to net zero, and we have global temperatures rising above 1.5 degrees. And that would be quite bad for a number of our markets. The most obvious one is Bangladesh, which would literally go underwater. That's a thriving economy right now. It's an important market for Standard Chartered. We have a leading position, and they don't have the fiscal resources to relocate people to high land. Not that there is much high land anyway. So that's just the obvious one. But 19 coastal cities in Africa with more than 1 million people that would be severely affected by climate change. And then inland, India and sub-Saharan Africa, would also be very, very affected by regular temperatures above 50 degrees. So it would render big parts of India uninhabitable. So that's the risk is clear. I think that's well understood. The opportunities are many. So we've done a lot of really good research, and I would point you to research that we've done like Zeronomics or more recently, in fact, just last week, a research piece called Carbon Dated, which looks at the impact on the supply chains of MNCs who are adopting net zero transition commitments. And no surprise, I mean, three-quarters of the greenhouse gas emissions of MNCs broadly come from their supply chains, and a very high proportion of those supply chain providers are in developing countries. So the idea that somehow Nigeria or Ghana or Sri Lanka are going to escape because maybe the governments are a little bit less focused on this, I'm not sure that's the case, that's not going to happen. That's the bad news. The good news is these companies can all make their transitions with the proper financial support. That financial support is going to come from people like us. And there's nobody better positioned to do this. We have the technology. We can deliver the blended finance, so bringing some government money together with multilateral money, together with export credit agencies, together with local capital markets. We have the technical skills. We have the client relationships. We have the credibility. And there's a tens of billions of dollars of financing opportunity for us, and we should be able to profit from that.
Thank you. We are slowly coming to the end of our session today. I'm just anything you feel we have missed? Anything we should touch on before concluding today?
Look, the questions I often get are around operational resilience. I would just note that despite the fact that the bulk of our operations are anchored in Chennai and Bangalore, we have no challenges in terms of operational resilience, and our forecasting of the health effects in India suggests that we will not have much of a challenge. Probably not dissimilar to others, but that is not to say that my colleagues haven't been heroic in the way that they've dealt with this. They have been, and we're doing everything we possibly can to support them. But I think operationally we're in very good shape. As for the rest of the world, you haven't asked about U.S.-China. It's always an interesting one to navigate. The good news is our China business is, as I mentioned earlier, is going from strength to strength. And while the level of tensions is as high as it's been, or maybe higher, as we hoped, the level of predictability around government actions going in each direction is higher as well. So the concern that we're going to be the victims of collateral damage, I would say, have on the margin receded.
Perfect. I think this is a great note to conclude our session today. Bill, thank you very much again for making time and joining us at the conference this year. Really appreciate it.
Thanks for having me, Martin.
Thank you.